Today we'll talk a little bit more on choosing the right mutual fund. Before we talk of choosing the right mutual fund, let us understand what this mutual fund is. A whole lot of readers ask us very frequently, is it good to invest in mutual funds? Is it good to invest in SIPs or systematic investment plans? So you really need to understand what are these mutual funds and what they do. So mutual funds are funds that gather money from investors, and they put the money in either the stock market, or that's equity shares, or they put it in debt. So by debt we mean it could be government securities or any other debt instruments of the companies or corporates where they get an interest rate. So the debt part, if they invest your money in debt, it is relatively safe. If they invest it in shares, it becomes risky. So now, before you decide, you need to know whether you should buy debt mutual funds or equity mutual funds. We explained and said that debt mutual funds is kind of risky, is not risky. They invest in very safe instruments, so you tend to get your returns could be 6, 7, 8, 9, 10% as well. So debt mutual funds are relatively safe. Now, equity mutual funds are not very safe. Your capital is not guaranteed and you are not sure what kind of returns you will get. Now, the past track record of equity mutual funds show that they have in last 10 years generated pretty decent returns of 10, 11, 12%. In the more short term of last 1 year, it's bad. Small cap equity mutual funds have generated not very good returns, and so have mid cap mutual funds. So if you're looking at a very long term perspective of say 5 to 10 years, 15 years, 20 years, then equity mutual funds make sense because they tend to give you returns over the longer term. So now you ask yourself a simple question. When I invest in mutual funds, should I put it in equity mutual funds or should I put it in debt mutual funds? Now, as we said, debt mutual funds are risky. So if you are in your 40s, if you are in your 50s, if you are in your 60s, you cannot take the risk, right? So you tend to put very less amount in equity mutual funds and you park your entire money in debt mutual funds. So for example, if you are retired, you cannot take a risk. So you would put all your money into debt mutual funds. If you're young, in your 20s, in your 30s, you can take the risk. You can invest for a longer holding time of 10, 15 years. This is when you put your money into equity mutual funds. You're able to take risk and therefore you could get much higher returns than say bank fixed deposits. So this is debt mutual funds and equity mutual funds, and we've explained both. As we said, mutual funds take money from a little money from small investors and put a large amount of money in the equity shares or the debt segment of the market. So this is what mutual funds do. So now, when you're choosing a mutual fund, you should first think of your ability to take risk. If your ability to take risk is high, you want to put money into equity mutual funds. If your ability to take risk is low, as a retired person, then you should put money in debt equity funds. So the first thing a person should see before investing in mutual fund is he willing to take the risk? If he's taking the risk and ready to get higher returns or maybe no returns at all, he can look at equity mutual funds. If he's not ready to take a risk, he can look at debt mutual funds. A second thing you should look at, and investors should always look at, is his age. If he's in his 50s, 60s, as we said, you should not be taking the risk. You should park your money more into debt mutual funds. So you should leave equity mutual funds. Now, the question often arises is, let's say you want to put, you're young, 20s, 30s, you want to put in an equity mutual fund. The question that people ask us is, which is the right mutual fund? To be honest, nobody would be able to tell you which is the right mutual fund. If somebody's trying to tell you this is the best mutual fund and that is the best equity mutual fund, the answer, you cannot predict. Why? Because in the stock market, things are so dynamic. A fund which has invested heavily into a particular share, if that share collapses, the full fund collapses. So really there is no guarantee that this equity mutual fund is the best or that mutual fund is the best. Yes, in terms of track record, if you see the large cap mutual funds, Then SBI Blue Chip Fund has done well. HDFC Equity Fund has done well. ICICI Prudential Value Through Life has done well. These are the mutual funds that have done well in the past. So you can look at the past track record before investing. But again, as we said, the past track record is no indication of future performance. What it means is that in the past, if the mutual fund has done well, there is no guarantee that it will do well in the future. So really speaking, nobody in this world can say that invest in this mutual fund, equity mutual fund, and it will give you the best return. That's not possible, because it's very, very dynamic, and funds that have performed well in 1 year have not consistently performed well in the other year. Now take a look at a couple of years back, everybody said put in mid-cap mutual funds, mid-cap. But if you look at the last 1 year return, it's negative in most of the mid-cap and the small cap mutual funds. So really speaking, nobody can predict the market. Nobody can predict how a mutual fund would perform. So it's best to, in case you don't know how a mutual fund performs or how it can perform, you can seek professional advice. But that advice, as you said, is no guarantee that this would be the best performing mutual fund. If everybody knew this was the best performing mutual fund, all the money would go there, and the rest of the folks would, rest of the mutual fund, equity mutual fund schemes would receive nothing. So it's really difficult to say. You need to do your research. If you have any query, feel free to write to us. And also we have a mutual fund section where you can read and gain information and all kinds of knowledge. Please log into www.goodreturns.in for more information.